So welcome to another episode of the Shay Sharma Show. Today we have Jackie Ellis from the Ourboro team. She's the manager relations team. And here we're going to talk about everything that Ourboro does, how it brings value to the marketplace, what's the problem we're trying to address, which is pretty much addressing the needs of the first-time home buyers, helping them get a foot in the door in the Canadian or the GTA-specific, Ontario-specific real estate market, and how best Ourboro can help you guys achieve that dream. Welcome, Jackie.
Thank you, Shay, for having me. Really excited to be here today.
Excited to have you today. And I just have some information about Ourboro here just to get us started. So your mission statement really says dedicated to unlocking home ownership. And that's exactly what you guys do. I've been following you for a couple of years now, for pretty much as long as you've been around. We've met a couple of times in the office. I've always wanted to get you on the pod. I know for sure you'll be able to bring a ton of value, but I know Ourboro delivers what it promises to deliver in terms of the dream that all first-time home buyers aspire about in terms of getting a foot in the door, getting their first home, so on and so forth. Now, you've helped over 130 first-time home buyers, unlocking or investing in homes worth over 120 million to date. You serve in 12 regions all across Ontario, and you have 1,800 relationship partners in the form of salespeople and mortgage brokers. I'm one of which. So help us understand the problem that Ourboro is trying to solve and why the company came into existence in the first place.
Yeah, happy to. Just a couple of updates to those numbers. We're now over 150 and we're well over 2,000 in referral partners right now. So we're really thrilled about the momentum that we're seeing there. But to answer your question, Ourboro was really formed as a direct response to this market gap that has emerged because of the divergence between housing prices and income. And, we know that residential real estate is one of the most stable forms of generational wealth creation. And because of that gap, fewer and fewer folks have access to not only, just as simple as the security and the stability of homeownership just from a shelter perspective, but also homeownership as an investment vehicle. And there was a recent Stats Canada report that suggested that you are twice as likely to own your own home if your parents own a home versus those who don't have that generational stake in the marketplace.
Right.
So as a result, a third of Canadians who are buying homes today are getting help from the bank of mom and dad. And so for that segment of the population who don't have access to the bank of mom and dad, they're kind of left, doing their best to save up as much as they can, as quickly as they can to get that lump sum needed for a down payment. But the longer it takes, the further priced out they could be potentially in the market, and they're kind of left in the dust. So that's very much where Ourboro comes in. It's defeating if you're doing your best to save up that down payment, but you're not getting any further ahead. So if the issue is the down payment gap, then that's very much the problem that we're trying to solve.
Right. And you're absolutely right. It is defeating because even if you're saving for months and years altogether, the fact is the wages have not caught up with the house prices. It just keeps slipping away.
Exactly.
You're never able to save up 5, 10, 20% because the prices keep going up. And we've seen in the GTA, if we look at the data and go back to 30, 40, even 70 years, we've seen 7% average appreciation year-on-year compounded for the last 40 years for sure.
Yeah.
Right. So I absolutely understand the point that you're trying to make here. So how does Ourboro come in when it comes to the down payment? Do you help with the entire down payment or a partial percentage? How does that work?
So we will help with, when you work with us with Ourboro, our combined down payment will always be 20%. So we are an equity investor. So we provide that down payment assistance up to 15% of the purchase price in exchange for a proportionate share of the future appreciation of the home. So we will come in, we'll contribute in that initial investment, and then we don't see anything until a homeowner decides to sell the home or they buy out our share.
Okay. So the homeowners have to come up with a minimum of 5%.
Exactly.
And you can contribute anything above.
Yeah.
And the maximum it has to be is 20%.
Exactly.
Do you go over 20% as well?
We do not. No. So the combined down payment is always maxed at 20, but no less than 20 either.
Okay. And then the mortgage starts. Obviously, the applicant, the homeowner, has to qualify for the mortgage. So how do you guys assist in that process? Take me step by step in terms of how, when an applicant comes in, how do you vet them? Do you have your own lender network that you work with, and how do things go from there?
Great question. So as far as the intake process goes, we try to keep it as simple and straightforward as they can. So they just need to complete an application. Our criteria is pretty, as I said, straightforward. So they need to have that 5% available to them in savings. They need to be looking for their primary residence. They need to be able to, qualify for a mortgage, which we would connect them with a mortgage professional if they're not already working with them, to help facilitate that. And be looking, within our coverage area, specifically, the GTA and those secondary markets that we cover as well. And then they'll have a call with our intake team who will answer any questions that they might have. And then if they're good to proceed, we send them to a mortgage broker who will help work with them on a mortgage pre-qualification. And then we onboard them. If they're working with their own realtor, that's great. They can go hit the market.
Okay, so the mortgage and the real estate salesperson, these people don't have to necessarily be from your team. They can be from anywhere outside the team as well.
Yeah, our only stipulation, our only requirement is that they create an account with us just so that we can provide them with the necessary information. Right. It's not confusing or complicated to be an Ourboro partner or work with an Ourboro buyer, but there is important information that we need to provide to them.
Right. Gotcha. And you mentioned GTA and some secondary markets as well.
Yeah.
So what are those markets? What are all the areas that you cover within Ontario?
Sure. So we are in the 7 regions of TREB. So Toronto, York, Dufferin, Peel, Simcoe, Durham, Halton. And then we just recently expanded to the City of London, Kitchener-Waterloo, Hamilton, Guelph, and Ottawa. So we're just within those kind of the urban centers of those secondary markets. We're not in the outskirting regions, but yeah.
Great. And that's a broad area as well. That's pretty much 70%. Safely said 70% of the population centers in Ontario.
Yeah.
I apologize for anybody who is offended by that.
We got a lot of asked about Windsor and St. Catharines.
Yes.
Not quite there yet.
Yeah. So it's essentially a shared equity program, right? So you guys partner up with first-time buyers. First-time buyers are then responsible to make their own mortgage payments as they would have done in any other situation, be it, they buying the property all by themselves or with another investor. So how is investing with Ourboro as a down payment partner different from, let's say, investing with your uncle or investing with any private investor in the open market?
Yeah, I mean, I can't speak so much to the devil is in the details with private lenders and those sorts of arrangements. So I can't speak to that, too much. But I think we would all agree that any sort of asset ownership with a family member or a friend can be tricky and it can be murky. So
especially when you're sharing the space and living under the same roof.
If you're living together too. So that's one, we're not living with you.
Yeah.
We will provide that down payment assistance and then we're pretty well hands off. But the difference being that we are also professional co-ownership. So we have a legal document that we require that our home buyers review with their own lawyer so that they fully understand their terms and conditions and their rights and obligations as it pertains to the co-ownership agreement. It also just comes with an entire team of real estate professionals who are very much invested in setting up our homeowners for success. So we've got an investment team. Our homeowners have their own team who support them throughout their homeownership journey. And then, of course, our intake team who helps all of our home buyers. So they have a whole company behind them who wants them to succeed, and we'll do everything we can to ensure that happens.
Great. And I know the Government of Canada also offers a similar program, which is a shared equity program, which helps with the down payment. So how does this program, differ from the government's?
Great question.
Yeah.
So that program doesn't exist anymore. They shut that down.
Thank you.
So other than that fact that we're still around and they are not, it was just structured a little bit differently than our program in that it was more a second mortgage. So they registered a lien on title. There was an expectation of repayment. And for us, because this is a straight equity investment where our investment will either appreciate or depreciate at the exact same rate as the homeowners. So if they end up having to sell the home at a loss and our initial investment is wiped out, we walk away with nothing and, kind of go on our way. So different in that way. So we're sad to see it go. Obviously, if it was helped even a few home buyers, that's a win. But the silver lining of that is that CMHC actually invested $5 million into our fund, which we deployed within a matter of months alongside Ontario Homebuyers. And that's a real testament to the need and the necessity for these alternative solutions in today's real estate market.
Absolutely. So what's the average timeline, let's say? So once you get into a contract, you've managed to get somebody in their first home. What's the ideal timeline from the first-time homebuyer's perspective and from Ourboro's perspective to sell the house now?
So in the co-ownership agreement, the maximum length of our term is 30 years, and there is no minimum term. So they could co-own with us for 2 months or 29 years. It's up to them. That being said, we've always kind of targeted a 10-year timeline when we're sort of modeling this out. That seemed to be kind of the sweet spot. Obviously, that timeline is not going to apply to everybody, but we have to imagine that nobody wants to be sharing appreciation with us going beyond kind of decades worth of appreciation, which can be fairly significant. And if they were planning on buying out our share, and I know we'll probably talk about exit strategies in a bit, but if they wanted to buy out our share and they're waiting until 29, 30 years, that could be financially prohibitive for some folks. So 10 years is kind of the target timeline.
Right. And that makes sense even when you look at the numbers and study the market for the last 30, 40 years. Roughly 7 to 10 years, considering 7% appreciation, 7 to 10 years is when the property prices double in value, which means the initial investment that the first-time home buyer has put in has multiplied by, a factor of X, 2, 3, 4, whatever that is. And then they are well set up to take their equity out and perhaps invest elsewhere and get a place of their own.
Yep.
Right. So that makes perfect sense. Yeah, for sure. So now talk about the lenders. Like who do you work with? Do you work with the big five? Do you work with, let's say, the subprime lenders or the private lenders or all of them?
So we do have specific lenders that we're able to work with. And just for some context, shared equity as a source of down payment is still fairly new in Canada. So not all lenders will accept that as a source of down payment. So we have to work with specific lenders, and we are always actively working to add more lenders to that kind of network. But as it is right now, we work with Equitable Bank, Community Trust, and Home Trust. We, from time to time, will have pilot programs. We have one going with one of the big five right now, and we are in talks with a couple of other A lenders right now as well that we're hoping to have on board in the coming months, because the goal is always to have as many options for our home buyers as possible so that they can shop around for the product that works best for them.
And in terms of the qualification now, do the ratios work the same way as they would if the home buyers were going alone, or do they work different? And by ratios, I mean the gross debt ratio, the total debt ratio, and all the other good stuff that the lenders look at while trying to qualify someone for a mortgage.
Yeah, I mean, the mortgage side of things is kind of agnostic of our program, because again, this is not a debt product, so we don't count towards their ratios at all. So, but it does mean that if they were originally shopping for a mortgage and they would have to qualify at 97% LTV, they only have to qualify for 80% LTV with us. And some of those lenders have extended ratios, and they can be a bit more flexible with the ratios than maybe the other lenders might be. So they might be able to qualify for a bit more, but the ratio requirements would be the lenders, and it makes no difference whether or not they'd be working with us.
Got it. And let's assume now, an applicant is in their first home, and now they've been living in the home for a while, and now they want to do some renovations, some changes, just to make the house more functional and usable for themselves. Now, how would that work? Would they have to come to you for, let's say, discussion, sort of a permission? And then what happens when they decide to make certain renovations? How does that work out?
Yeah. So that's our renovation credit program that we have for all of our homeowners. They only need to come to us for approval if really they're doing major jobs. So if there's a permit needed, or if it's going to be, a major job, $10,000 or more, then we have the great homeowner portal. It's all online. They submit a request. Our investment team reviews it, will very likely approve it. But then also they'll know if they're eligible for renovation credits where, to your point, if they are doing any upgrades to the home, if they were redoing a kitchen or they're adding a bathroom that will increase the home's value, Ourboro ultimately is going to benefit from any upside that is created from those renovations. So it really is only fair that we would contribute towards the cost of those renovations.
Right.
So, after the work is done, again, they can just submit online for a renovation request or renovation credit determination. The investment team will have a look and we could potentially cover up to, 100% of the cost of those renovations.
Okay. And would that assessment be done by an internal team or a third party?
Yeah, no, it'll be done by an internal team. And it would be, just sort of having a look at the comparables and seeing what kind of renovations add how much value and then basing their determination on that.
Okay. Another similar question, like related to the use of the house itself. Let's say a buyer decides to get a semi-detached or a detached house, and now they want basement to be finished and then rented out.
Yep.
Now, again, it's substantial value, number one. And number two, it's really going to increase the value of the property itself. The asset type is now going to change because it's giving rental income in return. So who pockets the rent? So we understand the cost involved might be shared between the homeowner and Ourboro, but who pockets the rent at the end of the day?
The homeowner.
The homeowner.
Yeah, we're not entitled to any rent.
And is there a restriction in terms of how they use that money? Does that have to go towards the mortgage, or is it for them to choose?
For them to choose. If they're dealing with the tenant and doing all of the hard work that landlords do, then they get to keep that money.
Okay, sounds good. That could be like a very big value add, I think, because that obviously in today's market, people are looking for options wherein the rent kind of offsets the mortgage. And it does substantially, like even at 5% interest, and we're seeing lower interest right now, even at 5%, we're roughly paying $500 for every $100,000 in mortgage. And even a one-bedroom basement rental gives you like $1,500 in Toronto.
For sure.
So you're looking at offsetting about $300,000, which is, again, a big deal for many homeowners.
Yeah. For sure.
All right, let's talk about the exit strategy right now. So now selling obviously comes in with a lot of cost, right? There's real estate commissions, there's staging and all of the other stuff that you have to do just to present the house well, and what's presented well sells well. Now, do homeowners have to take on all of those costs, or is that divided between the two parties?
Yeah, so because our homeowners have 100% of the rights and enjoyment to the property, and Ourboro doesn't see a dime until the home is sold, and that's only if there is appreciation.
Right.
The traditional cost of homeownership, including closing costs and the sale of the property, would be the occupying homeowner's responsibility, because they are getting the benefit of that property for the duration of how long they've owned it, and so they would bear the cost of selling it. The caveat to that is that we have a selling bonus program. So. To your point, I think you said that the average appreciation in the GTA, the historical average, has been 7% year over year. That's our sales target for the homes in our portfolio. So if the selling price meets or exceeds that target, then they'll be eligible for a selling bonus where we will kick in towards those closing costs, depending on how much the home has sold for.
And how much is that target rate?
7% year over year.
Oh, 7% exactly.
Yeah, exactly.
Okay.
And then on the purchase of the property, we will contribute our proportionate share of the land transfer taxes, which make up a pretty big chunk of those closing costs when you're buying a property, especially if you're buying in Toronto.
Yeah.
If we have a 60% equity stake, we're covering 60% of the taxes.
Okay.
And for, the majority of the buyers that we are working with are first-time home buyers, and they'll be eligible for the first-time home buyer land transfer tax rebate. That's a mouthful. And they'll still be eligible for it, and it would apply to their portion only.
Got it. And just to clarify the point on buying in Toronto, we say it's a massive chunk because you end up paying the provincial tax as well as the municipal tax. So it's double than if you buy anywhere outside of Toronto. So yes, that is a big chunk. And if I understood that correctly, it's the exact proportion of your down payment.
You got it. Yeah.
Got it. Okay. Now, we are at the cusp of some really big changes, right, when it comes to the real estate industry. 2 or 3 really clear out at this moment. Now, one's definitely the interest rate cuts that we've seen. We've already seen 3 cuts. We have 2 more announcements come in October and December. Hopefully, fingers crossed, we'll have 2 more rate cuts, 25 each, maybe a 50 in there somewhere. Let's see. The other one is the new regulations that coming, which we'll be talking about in just a bit. And the third, in my opinion, is the seasonality of the market, which we see every year. We know a big chunk of transactions, 50% or even more sometimes, happen during the months of February and June. So a lot of home buyers enter the market in February, let's say immediately after the festive season. They want to start putting in offers sometime immediately after, lock in something so that they can close on it, let's say before the onset of summer, and then move in and enjoy the rest of the summer in the new house. Now, with all these changes, we do expect the market activity to pick up slightly come spring. It will pick up slightly in fall as well, but come spring, it'll pick up more so. All these changes, how do you think the real estate market overall might be impacted, and what's the role that Ourboro might have to play in all of this?
It's so funny because anytime we try to predict what the market is doing, I'm just talking like on Ourboro's side.
Yeah.
Typically summer is a bit quieter, and our summer was incredibly busy. So, I mean, I think in combination with each other, the rate cuts, the new government of Canada sort of regulations around that 20% threshold, or the insured mortgage threshold, I think we're in for a pretty busy, even fall, spring, winter, who knows, but definitely certainly going into spring for sure. I would imagine it's gonna.
Right. Yeah. And the change in rules as far as the insured mortgages are concerned. So earlier, home buyers were able to buy up to $1 million, not touch $1 million, but let's say 999,999. If the purchase price is at that point or below, they were able to buy with minimum down payment. And now that limit of $1 million or under has been increased to 1.5, right? How does that change your role as an organization?
Yeah, it'll be interesting to see how that plays out. And, the encouragement would be for anybody to, and even, we encourage them if they're thinking about working with us, is to crunch the numbers, like talk to a professional that you trust and figure out the math and do your due diligence and make sure you have a grasp on, especially with these new regulations, having a higher amount of debt for a longer amount of time, plus the insurance premium that comes along with that price point is not immaterial. So you really would have to sort of noodle around with the numbers and make sure that those make sense to you. But if it unlocks a segment of the market that was inaccessible to folks before, where the down payment piece is the only issue, they're able to qualify for that much of a mortgage and carry that much of a mortgage, then that's great. For us, it's going to be business as usual. We're here for the people who, maybe want to lower those monthly carrying costs. They don't want to have to qualify for as much of a mortgage, or they don't want to pay that insurance premium, or, truly they just don't want as much of a mortgage. Then that's very much what we are here for. And, a good chunk of our homes are under $1 million, where they only would need 5% or 10% anyway. So, we'll just carry on doing what we do. But again, any of these new sort of innovative thinking and trying to help the market, or trying to help first-time home buyers is a great thing.
Right. And just as perhaps the last two segments, I don't want to call them questions, but two segments. I do want to take an example of, let's say, a $900,000, $1 million property, and then just run some numbers.
Make me too math.
No, very, very, very rough maths, very rough.
You're giving me a lot of credit.
Because I just want to make people understand in terms of how this works. I mean, theory is all good. I'm sure people have a better understanding of the product now versus 20 minutes ago. I think we are 20 minutes into the conversation. But anyway, so I do want to take an example and with numbers try and explain what it means for somebody who's watching and listening. And then any other services perhaps that we haven't spoken about yet that you feel are pertinent to the discussion and to anybody who's listening, something that we haven't touched upon.
Yeah.
It's an open-ended question where you can, just talk about some of the value-added products or services that you have to offer.
For sure.
Yeah. So let's go with the services first.
Okay. So services first. So we can speak to sort of what our homeowner perks look like. And I know we did already touch on the renovation credit program, which is great. But then we also have in the, in the spirit of setting up our homeowners for success, we've got a home maintenance program where Ourboro will pay for twice a year, home services. So things that nobody wants to do or knows how to do, i.e. eaves trough cleaning. Nobody wants to clean their eaves troughs.
Yep.
Furnace maintenance. We will pay for that twice a year for as long as they co-own with us, as well as, just home check visits to make sure that, again, for first-time home buyers who may not be overly savvy when it comes to home maintenance, and it's an intimidating thing to take on, owning your own home. So, trying to support them as best we can through those kinds of services is a real value add, we think, for our homeowners. We also have something called a rainy day fund. So it's a homeowner advance fund where if any of our homeowners ever were to encounter a time of financial distress, if they lost their job or they were at risk of not being able to make their mortgage payments for whatever reason, we set aside some money for them so that they have that bit of safety net in the, in those sort of unfortunate circumstances that we provide to them. And then again, just kind of touching on the fact that they've got a whole team of real estate professionals behind them who want to set them up for success. So.
Right. No, those are great services, I must say. And I'll touch upon a little bit more on a couple of those. So upkeep and maintenance. Now, you're absolutely right. Some homeowners, especially because we deal with, people from all over the globe, and this is like a melting pot of, different cultures, ethnicities, people coming from all over the globe. So sometimes it's very hard for people coming from elsewhere to even preempt what the maintenance and upkeep might look like.
Yes.
So knowing that you have a partner who's not only going to tell you what exactly is to be done to, keep the house in a good shape, but will also contribute towards the payments, I think that's a great value add. And you also talked about the rainy day fund. So how much is that? Like, is it like a few months of payments, or what does it look like?
It's 3 months worth of their mortgage payments. So we sort of thought that would be a 3-month buffer, hopefully is enough time for them to get back on their feet or, find another job or whatever the case may be. But it would be 3 months worth of their mortgage payments set aside for them in that fund.
Right.
Yeah.
Sounds good. And now let's go with our exam.
Okay.
So with the new rules, I think $1 million is something we can consider. That's perhaps your average townhouse in a good neighborhood. So so let's take $1 million and take us through how that would look like for anybody who's considering partnering up with Ourboro.
Sure. So why don't we'll use a 50-50 example just to keep it simple. So you're buying $1 million townhouse in today's market or before the new regulations come in. So you need 20% down. So if you as a home buyer, you've got $100,000, but you're still $100,000 short, you want to work with us. So we would contribute our $100,000 and then we have a 50-50 equity split. You hang on to the home for as long as you want to. When you do decide to sell, and let's just say it sells for 1.3. What Ourboro is going to get is our initial investment, so that initial $100,000 plus our share of that $300,000 growth. So we would get $250,000. The homeowner would then get everything else. So whatever you've paid off of the principal of your mortgage, that gets returned to you as a priority payment. You would get your share of the profit and your initial down payment. Now, on the flip side, if that $1 million home were to sell for $800,000, the priority payments still remain the same in that, the lender gets paid back first, obviously, but then whatever principal you've paid off of your mortgage would still be returned to you as a priority payment. Okay. And then because our initial investment has been wiped out, we walk away with nothing. So that's what sort of distinguishes us, or that's what does distinguish us from a debt product, in that if we were a debt product, we would be getting back our $100,000 no matter how much value is lost in the home. And that would be something that you would owe us. Whereas because this is an investment that will appreciate or depreciate at the same rate as yours, then if we lose, then we're losing right alongside you.
Right. And that's, again, is a big point for me and for a lot of people out there as well, because you're not a debt product, so your interests are completely aligned with the homeowner's interest. You both want the house to be in a good shape, it to appreciate in value, and then once you sell, again, you get proportionate shares, and as you said, you all win.
Yeah.
Who's the ideal partner? Like, who should invest with Ourboro?
Yeah, great question. And I always sort of just like to speak to that by first saying that we are emphatic in saying that if you can own a home on your own, then do that. That is the goal. And that is, in an ideal world, everyone would be able to own a home on their own. So if you can do it, do it. because we are often incorrectly, compared to owning a home totally on your own. Whereas, really the comparison should be made to renting. And, at very least, you've got your foot partially in the door of the real estate market versus, not having it in there at all. So that's one thing I want to start with. But as far as who should be investing with us, I mean, it's folks who check all the boxes. For all intents and purposes, you should be able to own your own home, but the down payment piece is the missing link to you being able to get into the market. So, all of the information, our qualifying criteria and all of that is all on our website. And we do very much encourage anybody who is interested even slightly in working with us to, again, do your due diligence, do your numbers. We've got lots of great calculators on our website where you can kind of input your own buying scenario and what your purchase price is looking like, what you think the average appreciation would be. So then you can kind of calculate what your returns would look like and determine whether or not it's the right fit for you.
Right. And obviously you can benefit first-time buyers and they can, achieve their dream of getting their first home, but you do have investors as well, right? People on the other side of the table now. You are a growing organization, so many people would want to work with you, invest with you, and then grow their, book of business through those channels.
Yeah.
So if somebody is looking to be your partner on the investment side, how do they do that?
Well, we work with accredited Canadian investors. We have, we're really lucky that we have great partnerships with, pension funds. As I said, we've had the CMHC program invest in our fund. Peerage Capital is one of our anchor investors. So we're very lucky to have partnerships with those folks. But if anybody is interested in, exploring investing with us, we've got an investment team that we would be happy to connect them with. They would just need to get in touch with us through our website.
Sure. Thanks. And now talking about first-time home buyers again, how do they get in touch with you? Do they give you a call? Do they, submit a form on the website? What do they do?
They can get in touch with us in a myriad of ways. So we have a 1-800 number. We've got a get in touch feature on our website. You can DM us on Instagram or, whatever social media platform you use, but there's some way that you can get in touch with us. No problem. We'd be happy to talk with you.
All right. Perfect. Jackie, thank you again for your time today. I'm sure this would bring a ton of value to a lot of listeners out there. And thanks again for doing this.
Thank you, Shay, for having me.
Thank you.